In other news, the shortage of US dollars continues to take a toll on the country's economy, and with the latest hit being the low uptake of government securities. This is due to liquidity challenges experienced in the country, as Jasmine Murani tells us.
The negative shocks on the economy have continued to tighten liquidity in the market. This has manifested yet again through the low uptake of government bonds, an occurrence that continues to pile pressure on the exchequer's domestic borrowing targets for the current fiscal year.
Investors are looking for higher interest rates, and what is being offered to them right now for them is too low. So many of them are holding off, and they expect interest rates to go higher up. So many of them prefer to park their money in short-term treasury bills as they expect interest rates to go up.
In the last 10 months, since July 2022, a total of 28 bonds have been floated. Of this, 25 have been undersubscribed. Only 3 infrastructure bonds were oversubscribed. Infrastructure bonds make up 7 of all the bonds floated since July. Only 1 fixed coupon bond was oversubscribed. The cancellation of a reopened 15-year bond by the CBK has served as an indication of the government's struggle to raise debt financing from the local market.
The CBK was forced to cancel it because investors were becoming very aggressive, demanding very high interest rates, almost 14.5%. And for government, that is too high, that is very expensive. And it presents 2 problems. Number 1, it presents very expensive debt to be serviced in future, and it also presents a crowding out of the private sector. So the CBK is trying to rein in high interest rates to make sure the economy is on safe footing.
The dollar shortage, caused in part by the previous system of fuel purchase at the port, has affected liquidity in the market. President William Ruto moved to solve the predicament by introducing a government-to-government purchase deal that will reduce the dollar demand by about $500 million every month. Analysts say this is a problem deferred.
When we talk to oil marketers, many of them tell us that they deal in currency swaps. And in those currency swaps, they do have to look for dollars to be able to service that. So in terms of that move reducing the dollar demand, as has been stated in the media, I think it will be a marginal. It might not be to the full extent because there will still be dollars needed for the currency swaps. Number 2, the arrangement we have, the G2G arrangement, is a 6 months credit window. So after 6 months, that will still be required. Those dollars will still be required. So that's not changing. Maybe the time frame might change, but the demand for dollars and markets are very...
Jasmine Murani for KTN News.
Thank you, Jasmine. And in education news, Parliament has